Welcome, Avatar. Now that we're all on the same page regarding the future of DeFi and finance, it's time to learn how to use these protocols to generate yield in excess of your local bank offering 0.5% interest. The good news? There is a lot of opportunity in DeFi. You can certainly generate yields in excess of what you see in typical real estate investments and in the bond market. Before doing a walkthrough, here is an explanation on why this exists and why it likely will be successful over the long term. Some of this is already covered in the last video. This will be a useful reference point to see the direct step-by-step going from knowing nothing, to bank, to Coinbase, to decentralized exchange, to DeFi, to using DeFi, in a single video. Part 1. Liquidity pools, what is it? Yes, more annoying financial terms. This is a fancy wording that just means a bunch of money, stocks or coins in one spot. That is a pool. We can start with a simple example of fundraising, or an initial public offering, IPO. If you have a large company and you need to raise money, you have to go to a bank. This is generally the only option to raise a lot of money. Sure, you could crowdsource some money or find rich friends. However, banks are essentially liquidity pools. They know where all the money is and have access to all the rich clients. Here is how it works in steps. 1. You need to sell shares of your company. 2. You need to find people to invest in your company. 3. You go to a bank and they help you sell the stock with a massive 7% fee. And 4. The final most important part. They hold the shares and distribute. Think the last two parts through. If you wanted to buy, say, 1,000 apples, you'd need to find a centralized source for apples. This could be the grocery store or an apple farm. Now if you wanted to buy 1,000 shares of, say, new company X, then your options are quite limited. Why in the world is this system set up like this? It shouldn't be, it should be more decentralized. Final step, apply this to crypto. If you want to buy Bitcoin, you really have two choices. You have to go to a centralized exchange, or you have to go and find a way to do it peer-to-peer. By creating a decentralized exchange with a large liquidity pool, we can avoid a massive monopoly. Part 2. Use a decentralized exchange to create the pool without the banks. Usually you have to go to a bank or exchange to get your stocks, coins or money. Instead of overcomplicating this, we're going to use crypto to explain it. If you want some Bitcoin, you go to an exchange like Coinbase in the USA. Easy enough, you click buy and you have your coins, and you can then send it to a wallet. Alternatively, you can go and use a decentralized exchange. Since stocks and coins change hands every second, you put them into a pool run by software code. This way, you are trading peer-to-peer with software code in between, matching buyers and sellers. Part 3. Begin replacing Wall Street functions. Some geniuses said, hold up, if we already have a decentralized exchange of pooled coins, can't we just do the same stuff a bank does, like loan money out? This is exactly what happened. Now that you have a pool of coins and agreements can be made with smart contracts, you can match buyers and sellers of loans as well. Benefits of this new system. Well, if you are using Coinbase, everyone at Coinbase has to get paid. 1. The CEO needs to get paid. 2. Those servers cost money. 3. Customer support needs their money. 4. Office space needs to be paid for. 5. Regulatory costs, being compliant and avoiding fraudulent coins. And 6. Everything else, from HR departments to office furniture to VPNs to marketing, and of course, all the engineers that work there. All those 1% fees need to pay the entire staff, otherwise they would go out of business. Compare this to the other options. Here is an example on Yearn Finance, a team of about 20 guys grinding it out, focused solely on the code. Look at the results. Revenue per employee is $5.86 million. That is impressive to say the least. With 21 mostly pseudonymous team members, Yearn currently spent $133,716 in salaries throughout April. In contrast, robo-advisors Betterment and Wealthfront have 293 and 231 employees, while BlackRock, the world's largest asset manager, employs 16,500. Now the bad news. There are a ton of scams. In the end, you're going to lose some money due to scams. Even Mark Cuban got scammed when Titan went from $60 to $0. No need to be hard on yourself if you end up testing a few high-risk pools and lose some money on it. We've all been scammed at least once, and it will happen again, no doubt. If Cuban is not shooting 100%, don't expect to shoot 100% yourself. All Wall Street functions are being replaced by code. However, since all of this is new, the software systems, or in other words the pool and the developers working on this, could steal the funds. This is a major risk when dealing with DeFi. How to avoid a scam? A scam, also called a rug in crypto terms, is pulled off in a few ways. 1. Claim that the funds were suddenly stolen from the pool when the developers really just took it and ran. 2. An actual hack occurs that steals the funds. 3. Have a questionable stablecoin that is actually valued way below $1, so now people think they are earning say 20% returns, but if the stable trades at 70 cents they are actually losing money. And 4. Token issuance schedule is also a big factor. Simple ways to try and avoid it. 1. If you're new, only use established protocols that have been around for a long period of time. 2. Try to do your own digging and figure out if the project is being run by people who have started other successful projects. And 3. Tag some of the larger wallets and use that as a proxy for something being legitimate or illegitimate. The third part is extremely dicey. What we mean by this is the VCs have strange incentives. If they were early on a coin like with ICP, you want to avoid it. If they invest in a decentralized coin, with fair token launch, you probably want to take a look as it means they did work on the software code. Oh, and by the way, there are so many crazy projects out there, many of them don't even make money while others are making millions. So you have to do the work to figure out which ones you think will be successful long term. Part 4. How to use DeFi. Now that you understand the basics, here is a beginner's way to use DeFi. It's actually quite easy, but you'll find that there are millions of options. Instead of going through those right now, here you'll just see a simple example. For this part, we will need to relocate to the computer room. Step 1. The first thing you should get is a MetaMask wallet. Once you have this wallet, you can then send and receive crypto assets. I already have the MetaMask installed, and have already transferred some Ethereum to it. Step 2. You can start with any protocol, but for this video we will be using Sushi. First go to Sushi app. If you want to, you can then go ahead and swap some of your Ethereum to any token you like. Simply click the Swap tab and connect your wallet at the bottom. This is extremely easy. When the little MetaMask box appears in the right corner, you just click Approve, and then it is done. Here you can see me swap to some DAI token. Next up, we click on the Liquidity tab. Step 3. Now you have to decide, what do you want to add to the pool? This is where hours and hours and hours of research come in. Depending on what you put into the pool, you will get different returns on your assets. If you're adding liquidity for some dangerous potential scam coin, you'll probably see eye-popping yields of 100% or even 1000% for taking on that much risk. If you're trying to add Bitcoin and Ethereum, the returns will be lower. For this example, let's put in some DAI. You would then match this with an amount of equal worth of the other token of your choice. Step 4. People screw this up all the time. After you deposit, you're not done. After you are done with adding liquidity, you will have Sushi Swap liquidity tokens, called SLP. You must stake this, which effectively confirms you are locking your tokens into the pool. Go to the farm page and search for the pair you have chosen. If you forget to click approve here, you're earning nothing. Once you click approve and stake, you will see the ability to unstake. For extra caution, check the rewards you earned by the end of the day to make sure you did it correctly. You should be accruing rewards slowly through the day. If you want to get out of the liquidity pool, you simply click remove liquidity by clicking unstake. Click unstake and go backward and move your coins back to your MetaMask wallet. Step 5. Congrats! Your first taste of DeFi is complete. You definitely won't get rich with your first ever pool, unless you are ultra lucky and talented. But you will learn a lot from your first attempt. You will see the gas fees and total costs to do all these transactions, and you'll have an aha moment on why it is the future. While many think they are late, they are not. We're extremely early, and this is a good thing. Just like the internet and the computer, you can say, "I don't have time to learn this." But in the long run you'll use it anyway, so may as well learn the basics now. That's it for today's video. If you enjoyed it, and want to learn more about decentralized finance, make sure to subscribe to the DeFi Education Substack for more amazing content on the topic. Thanks for watching, and hopefully you are now one step closer to understanding why banks are zeros.